In October 1973, Arab members of OPEC halted oil shipments to the United States and other nations that had supported Israel in the Yom Kippur War. The posted price of crude rose from roughly $3 per barrel to nearly $12 by early 1974, a near quadrupling in months. Saudi Arabia, Kuwait, and the other Gulf exporters suddenly held dollar surpluses far larger than their own economies could absorb. Those dollars needed a home, and the Western banking system would provide one. Large U.S. and European commercial banks, including Citibank, Chase Manhattan, and Bank America, absorbed the oil exporters' deposits and needed to deploy them profitably. Latin American governments were eager borrowers. Commodity export revenues were rising. Real interest rates on the loans were low or negative in the inflationary 1970s. And the prevailing view in banking was that sovereign governments, unlike companies, would always find a way to repay. Walter Wriston, Citibank's chairman, expressed the widely cited belief that countries, unlike corporations, could not go bankrupt. That assumption would prove catastrophically wrong. Through the second half of the 1970s, Latin American governments borrowed at a pace that seemed sustainable only as long as global conditions cooperated. Mexico used the proceeds to develop the giant Cantarell offshore oil field and to fund social spending under two successive presidents. Brazil borrowed to finance state-led industrialization, building steel mills, hydroelectric dams, and state enterprises. Argentina borrowed under a succession of military governments to cover fiscal gaps. A crucial technical detail sat buried in the loan agreements. Most of the debt carried variable interest rates typically pegged to the London Interbank Offered Rate, or LIBOR. When LIBOR was low, the arrangement looked manageable. The risk lay dormant in that floating rate clause. U.S. consumer price inflation had averaged above 7% annually through the 1970s and was still climbing when President Jimmy Carter appointed Paul Volcker as Federal Reserve Chairman in August 1979. Volcker diagnosed the cause as years of monetary accommodation and moved to treat it with a sharp restriction of money supply growth, an approach often called the Volcker shock. Because the Fed stopped targeting the federal funds rate directly, the rate was free to climb. By June 1981, the federal funds rate reached approximately 19 to 20%, according to Federal Reserve data. The domestic goal was to break inflation. The international side effects would be severe. High U.S. interest rates pulled capital from around the world into dollar assets, lifting the dollar's value sharply. Depending on the measure and basket used, the dollar's trade-weighted value rose by an estimated 40 to 60% between 1980 and its peak in early 1985, based on Federal Reserve and IMF data. That appreciation delivered a two-sided blow to Latin America. First, the region's dollar-denominated debts became far more expensive to service in local currency terms. Second, commodity prices, which are globally quoted in dollars, fell as the dollar strengthened, eroding the purchasing power of Latin American exports. The variable rate debt meant that as U.S. rates climbed, so did the interest bill on every loan tied to LIBOR. Mexico's vulnerability crystallized faster than most observers expected. President José Manuel Pez Portillo had constructed his government's finances around the assumption that oil prices would remain elevated after the 1979 second oil shock. When global oil prices softened in 1981, rather than continuing to rise, export revenues disappointed. Capital began leaving the country as confidence in the peso eroded. Pez Portillo nationalized Mexico's private banks on September 1, 1982, in an attempt to halt the outflow, a move that proved ultimately ineffective. By mid-1982, Mexico's foreign exchange reserves had fallen to levels that could not cover imminent debt payments. The government had borrowed in dollars to fund an oil boom that had stalled, and there was no longer enough dollar income to service what it owed. In mid-August 1982, Mexico's finance minister Jez N. Silva Herzog contacted U.S. Treasury officials and the International Monetary Fund to deliver a message that would reshape global finance. Mexico could not meet its upcoming external debt payments. The sum was enormous. Mexico's total external debt stood at approximately $80 billion, much of it owed to a handful of major U.S. commercial banks whose capital would be severely impaired by a default. Federal Reserve Chairman Paul Volcker, Treasury officials, and representatives of the Bank for International Settlements worked through the following weekend to assemble a short-term bridge loan to prevent an immediate payment failure. The bridge bought time. It did not resolve the underlying problem. Mexico's admission shattered the presumption of sovereign invulnerability that had anchored the lending boom. Once that premise was gone, creditors scrutinized other borrowers in the region and found similar fragilities. Brazil, the region's largest economy, acknowledged debt servicing difficulties in late 1982. Argentina, already struggling with the economic aftermath of the Falklands War earlier that year, followed. Venezuela, Chile, Peru, and Bolivia soon joined what became a region-wide crisis. IMF period data placed total Latin American external debt at roughly $330 billion or more by the early 1980s. The creditor banks, concentrated among a small number of large US and European institutions, faced simultaneous stress that threatened to destabilize the global banking system. The International Monetary Fund, led by Managing Director Jacques de la Rosière, took on the role of central coordinator. The fund's model was to offer emergency financing only in exchange for structural adjustment commitments, reductions in government spending, privatization of state enterprises, currency devaluation to improve export competitiveness, and trade liberalization. Commercial creditor banks were simultaneously encouraged, and in some cases pressured, to roll over existing loans rather than demand repayment, preventing an immediate cascade of defaults. Critics of the approach, including many development economists and voices from within the affected countries, argued that the austerity programs compressed already struggling economies and imposed the burden of adjustment on workers and the poor rather than on the lenders who had made imprudent loans. For most Latin Americans, the 1980s became known as La Década Perdida, the lost decade. Real wages fell across the region. Poverty rates climbed in countries where they should have been declining. Several nations, including Brazil, Argentina, Peru, and Bolivia, experienced severe bouts of hyperinflation as governments printed money to cover fiscal gaps they could no longer fill through borrowing. GDP per capita in Latin America ended the decade roughly where it had started, erasing years of potential development. The human cost was not abstract. Social services were cut to meet IMF targets, and the political instability that followed reshaped governments across the region. A durable resolution came only in March 1989, when U.S. Treasury Secretary Nicholas Brady announced an approach that acknowledged what years of crisis management had avoided stating explicitly: a significant portion of the debt could not be repaid in full. The Brady Plan offered commercial bank creditors a menu of options, including the ability to exchange old loans for new, tradable bonds whose principal was collateralized by U.S. Treasury zero-coupon securities. Mexico concluded the first Brady restructuring in 1990, reducing its debt burden in exchange for committing to economic reforms. By giving the debt a transparent market price, the new instruments allowed investors beyond the original creditor banks to hold and trade it. In doing so, they gave birth to the modern emerging market bond market. The Latin American debt crisis left behind institutional machinery and financial instruments that shape global finance today. IMF conditionality, the practice of linking emergency lending to policy commitments, traces directly to the 1982 playbook. Brady bonds established the emerging market debt asset class that now channels trillions of dollars of investment. The crisis also revealed a structural pattern that recurs in sovereign debt history: a lending boom fueled by cheap money and optimistic assumptions about borrower income, a shock to either the borrower's revenues or the lender's cost of funds, and a reckoning that arrives faster than almost anyone anticipates. Analysts monitoring sovereign debt today still watch the same warning indicators that were flashing in 1982: heavy foreign currency borrowing, commodity-dependent revenues, rising global interest rates, and thinning foreign reserves. The tools have changed. The causal sequence has not. This is educational financial history, not investment advice, and nothing here is a recommendation, prediction, or guarantee. Do your own research and consider a licensed professional before making any financial decision.